In this lesson, using pivot points to trade, the learning objective is you should know how to trade using pivot points. The central pivot point is the strongest support or resistance band, while the other support and resistance lines are weaker. The more times a currency pair touches a pivot level then reverses, the stronger the level is. Let's look at how to trade using pivot points. Since pivot points are largely used to generate support and resistance lines, this system is traded like any other support and resistance system. As the market approaches them, some traders expect the price to rebound, others might anticipate the chance of a breakout. Consequently, they are important prices because they signpost the chance of significant movement. Behind pivot points you have displayed is a real world example. And as you can see, often when price bounces off these levels, or when it breaks through, it has a significant move, like a larger or longer, bigger body with lots of volatility. As you can see, there's the wicks, and the market just generally falls through or goes through it. It doesn't really slowly go through it. So a strategy for trading using pivot points, you could open a buy position when the price breaks above a resistance level and a sell position when the price breaks below a support level. Or you can just trade bounces. So when it touches a resistance level, you can sell, or when it starts to recover from a bounce off a support level, you could buy. I would recommend using it as a breakout level because it's usually easier to trade than the standard support and resistance level for pivot points. We can also use base pivot points as a way to gauge general direction. If the price is above the base pivot point, it indicates bullishness, and if the market is below the base pivot point, it indicates bearishness. You'll take a long position when there is a bullish market and go short in bearish markets. If you see that a pivot level is holding, you can sell when the market is at resistance, or buy when it is at support. You would aim to close buy positions when the market reaches resistance levels and close sell positions when the market drops to support levels. So just basically the standard support and resistance level trading. As with any technical trading tool, it is important to be cautious when trading pivot points. You can incorporate candlestick analysis and other types of indicators that help give you more confirmation. Most of the time, trading normally takes place between the first support and resistance levels. Occasionally, the price will test the second levels, and every once in a while, the third levels will be tested. Sometimes, price will just break through all of these levels. In conclusion, pivot points are used to capitalize on quick movements. Using pivot points makes it relatively straightforward to identify entry and exit points. Pivot points don't always respond well to intraday changes in trading activity based on news or other factors, so you need to be somewhat flexible when trading using this tool. A successful pivot point trading strategy will often incorporate other indicators to confirm your trades. If 2 or 3 indicators are saying the same thing, it makes a more compelling case for placing a trade.